Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by investment strategist Ryan Grabinski to talk all things markets as we head into the end of the year. Ryan, how are you doing today?
I'm doing well.
Great to have you back. It's a good week to talk. We got a Fed meeting, we got an inflation reading. Let's start with kind of the combination of those two things. So the Fed hiked interest rates 50 basis points the other day, which was a deceleration from their previous pace, but would still be considered, pretty aggressive by historical standards. So, what are your takeaways from that meeting, that press conference, and how does that impact how you all think about the Fed heading into a new year?
Yeah, certainly. So at the end of the day, the Fed meeting, obviously, you mentioned they raised 50 basis points. That is certainly viewed as a deceleration. Some investors are viewing that sort of as that pivot move. I don't think that's necessarily our view. At the end of the day, they are raising rates. It is still a pretty aggressive stance. I think the kind of the big takeaway from my perspective really is that the Fed believes that they have more work to be done in fighting the inflation front. Obviously, the CPI reading at 7.1% is pretty elevated. It's down from its highs, but still pretty elevated. I think the other thing that was a big takeaway is really related to what the markets are viewing the Fed's view. Obviously the markets are essentially telling you that they don't believe that the Fed is actually going to be able to get their terminal rate to that 5.1% that they're indicating. Looking at the Fed funds futures, the terminal rate is closer to 4.9%, which is obviously it's about one rate hike difference overall. I think probably the bigger takeaway when you kind of look at what the market's thinking, the market's actually anticipating cuts in the latter half of 2023, and that's not necessarily what Powell said in his commentary. He said they're pretty much going to hold steady for an extended period of time. And then lastly, I'd say the third thing that I took away from the meeting is really that it's gonna be all about jobs next year. At the end of the day, inflation has peaked, it's coming down. I think it's hard to argue against that. And for inflation to really come down further, we're going to need we're going to need the layoffs. Obviously, there's still a significant number of job openings out there, so the labor market remains strong. Really, to get that back to that 2% target, you need a weakening job outlook, which we're just not there yet, and that's going to be significantly more challenging, especially with the shortage of labor that we've seen.
Yeah, I think that's right. They were really honed in on the labor market, and that has wide ranging implications, right? So for the Fed, they see wage growth higher than the rate of inflation that they target, and they think they have to get that down. On the other end of the spectrum, you have companies, corporate operators that make up the S&P 500, the stocks we invest in, and they have to manage that wage growth as well, and that's a huge line item for a lot of businesses, especially in the services sector, and it weighs on profitability. So with that frame of the labor market in mind, I wonder if you could talk about how you are seeing corporate earnings for next year, and what that might mean, kind of for the S&P 500 or for the stock market as we go forward.
Yeah, certainly. So, obviously we've been pretty, I don't want to use less optimistic about earnings, for 2023 than most of the consensus at this point. We're expecting a decline of roughly 10% right now. I will say though, if you kind of look at the annual earnings growth rates and you look back to 1950, we have 11 periods or 11 years where earnings growth was actually negative 10% or greater on the negative side. And if you kind of match that up to what S&P performance was over those same years, you actually, in 9 of those 11 periods, you actually had positive performance on a total return basis. And the two exceptions were actually '08 and '01. So, obviously we know those were significant recessions. So the extent to which we avoid a really significant recession, there's always the possibility that the equity markets actually could rebound next year, even if we do have that decline, that large decline in earnings. Obviously, a lot of that is going to be, dependent on, the labor force. If to the extent to which individuals continue to have jobs, they're likely to going to continue to spend, whether it be on credit or they spend down on their savings. So I think from an earnings standpoint, obviously we're going to be focused on the jobs as well, but also obviously the Fed is focused on it as well. So.
Yeah, and so I think you painted a picture of what is a pretty kind of mixed or confusing macro environment as we head into a new year. The Fed tightening, inflation high, the economy cooling, but not quite enough. So it could be an interesting year. And with that in mind, I wonder, how are you all positioning your portfolios, and what sectors do you all like the most heading into 2023?
Certainly. So, we're a little more cautious. We have been all year. We're a little more cautious as we head into next year. We actually have a bias towards the defensive sectors. So consumer staples and healthcare are really the top of the list. And then, obviously with the consumer staples, it provides you a little bit of yield. Healthcare is always a more defensive sector. I think the one kind of outlier sector that we are overweight right now is actually energy. We're really overweight that because we really think there has been a change in the management from a management perspective, and what their view is that, they're really trying to return capital to shareholders, whether it be buybacks, dividends. They're more of these self-funding companies that we've gravitated towards over the last year. They're generating a lot of free cash flow. A lot of the pushback we get is if there is a recession, energy is going to sell off, and we don't disagree with that. But at the end of the day, during deep recessions, every sector ends up selling off. It's just a matter of picking the sectors that don't sell off the most.
Right. Yeah. As you mentioned, responding to both questions, avoiding that really hard landing in deep recession is going to be huge for markets in the next couple of years. Well, Ryan, I want to thank you so much for the time. I think you've given us some really good ideas and some actionable stuff heading into 2023, and look forward to talking to you again next year.
Thanks, Ross.